So when selling an inherited property, it could trigger certain taxable events in California. Notably, the sale of an inherited property might result in capital gains and additional tax consequences, which elicits a very common reaction.
I hate you. Hate, 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 hate. Double hate.
Loathe entirely.
So, what are the tax consequences of an inherited property in California? Well, in this video, we will address 3 tax consequences for selling inherited property in California from either probate or even a trust. So number 1 is estate taxes, number 2 is inheritance tax, and number 3 is property tax change due to Prop 19. Hi, I'm Harold Powell. I'm a local Ventura realtor helping people buy and sell in Ventura and the surrounding communities. Now, since I'm not a tax expert and can't offer tax advice, I recommend you actually consult with a financial advisor and tax expert in the year you sell an inherited property. This is the best way to ensure that you make tax-forward decisions and minimize your overall expenses. So with that, let's dive into the difference between estate tax versus inheritance tax. In short, the inheritance tax on a house refers to what the beneficiary is expected to pay, while the estate tax refers to the amount that's taken out of the deceased estates before the inheritance goes through. So the key difference between an estate tax versus an inheritance tax lies in who is responsible for paying them. The estate taxes are levied on the total value of the deceased person's money and property, less an exclusion amount. Now, the good news is there is no estate tax in California, and the federal tax exclusion amount for 2023 estate tax is now at a whopping $12.92 million. So, a large percentage of heirs don't have to worry about the estate taxes. Inheritance tax is a tax imposed on the heirs or beneficiaries who receive assets from the deceased person's estate. So, the next question is, when you sell an asset, or in this case an inherited property in California, what are the taxes on the sale of that inherited property? Well, the good news is that the IRS will use the stepped-up basis to determine inherited property capital gains taxes. Now, the stepped-up in basis refers to the adjustment in the cost basis of an inherited asset to its fair market value on the date of the decedent's death. The capital gains tax is paid on the difference between the inherited value and the final sale price. And if the decision to sell the property is sold within 1 year of the date of the death, you may not have to pay any inherited property taxes because of that stepped up basis. So let's take a quick look at an example. Let's say the decedent originally purchased the property for $200,000. The inherited property stepped up basis at the time of death is $1 million. The heir then sells the property 2 years later for $1.3 million. The heir would then pay capital gains tax on the $300,000 minus closing costs, and the remaining $1 million would not be taxed. So, now as a service to our clients, we also provide an estimate of value, which most CPAs will accept as a new stepped up basis of value for the property. The third tax issue is the property tax of an inherited property. Now, under Prop 19 that was just recently passed in California, it allows for the transfer of the property tax between parent to child, provided the property continues as an owner-occupied family home. If the new family member does not use the property as their primary residence, then the property will be reassessed at its current market value, resulting obviously in potentially higher property taxes. So only the primary residence status is eligible for this exemption from reassessment. Other inherited properties such as vacation homes, investment properties are subject to reassessment based on the property's current market value. Thank you for watching, and I hope you found this of value. If you did, go ahead and hit the like button as well as the subscribe and bell icon to be notified of future videos.